Hello everyone and welcome back. Today we are diving deep into what might just be the single most disruptive exchange-traded fund to hit the European market in recent years. If you are a European investor looking for a simple one-fund portfolio, you have probably been told for years that the Vanguard FTSE All-World ETF, commonly known by its ticker VWCE, is the undisputed king, and for a long time it truly was. But recently, a massive challenger entered the arena and completely changed the landscape. I am talking about the Xtrackers FTSE All-World UCITS ETF 1C, trading under the ticker ALLW. Let us get right into the numbers and why this fund is making such massive waves across the investment community. The Xtrackers ALLW ETF tracks the FTSE All-World Index, which is essentially the gold standard for global equity investing. It is designed to be the only stock market fund you will ever need to hold in your portfolio. But the biggest headline here is the cost. The total expense ratio, or TER, of this Xtrackers ETF is just 0.07% per year. To put that into perspective, the Vanguard equivalent VWCE has a TER of 0.14%. While a difference of 7 basis points might sound incredibly small on the surface, anyone who understands long-term compounding knows that costs matter immensely. When you are holding a core fund for 20, 30, or 40 years, halving your expense ratio can leave thousands or even tens of thousands of euros extra in your pocket at retirement. DWS, the German asset management giant behind the Xtrackers brand, deliberately priced this fund at 0.7% to undercut Vanguard and iShares, making it the absolute cheapest ETF that tracks the FTSE All-World Index currently available to European retail investors. So, what exactly are you buying when you invest your hard-earned money in ALW? Let us break down the underlying index. The FTSE All-World Index is an incredibly broad international equity index. It tracks roughly 4,200 companies from both developed and emerging markets worldwide. By investing in this one single fund, you are capturing between 90 and 95% of the entire investable global market capitalization. You do not have to worry about manually rebalancing your portfolio between a developed world fund and a separate emerging markets fund. The index does all of that heavy lifting for you automatically. Let us look at the geographical breakdown as of mid-2026. Unsurprisingly, the United States dominates the portfolio, making up about 57.75% of the fund. This is followed by Japan at 5.8%, Taiwan at 3.41%, and South Korea at 3.09%. The rest of the world makes up the remaining roughly 30%. If the global economic balance of power shifts in the coming decades, say if European or Asian markets begin to outpace the US, the fund will naturally adjust its geographic weights over time without you having to lift a finger. You are quite literally betting on the progress of human enterprise across the globe. From a sector perspective, technology takes the undisputed lead, comprising 31.94% of the fund's assets. Financials come in second at 14.1%, followed by industrials at 9.77%, and consumer discretionary at 8.73%. If we zoom in on the top 10 individual holdings, you will see the familiar tech giants that have been driving the bulk of global market returns. Nvidia is currently the largest holding at 4.69%. Apple sits closely behind at 4.10%, with Microsoft at 2.68%, Amazon at 2.26%, and Alphabet right behind them. You will also find international powerhouses like Taiwan Semiconductor Manufacturing Company holding a prominent 1.78% weight in the fund. The beauty of this structure is that while these massive tech companies drive the top end of the portfolio, your downside risk is distributed across thousands of other companies worldwide. Now, let us discuss the fund structure, which is a crucial consideration for any European investor. First, you will notice the term UCITS in the name. This stands for Undertakings for Collective Investment in Transferable Securities. In simple terms, it means the fund is fully compliant with strict European Union regulations designed to protect retail investors. Additionally, this specific share class, designated as 1C, uses an accumulating distribution policy. This means that the dividends paid by those thousands of underlying companies are not paid out as cash into your brokerage account. Instead, the fund manager automatically and efficiently reinvests those dividends back into the fund. For most retail investors across Europe, this is highly tax efficient because it prevents a taxable event from triggering every time a dividend is issued, allowing your investments to compound much faster over time. The fund is domiciled in Ireland, which is standard practice for UCITS ETFs because of the favorable tax treaties Ireland holds, particularly regarding the reduction of U.S. withholding taxes on corporate dividends. The replication method is physical, specifically using an optimized sampling technique. This means Xtrackers actually goes out and buys the underlying stocks, rather than using synthetic financial derivatives like swaps to mimic the performance. Because buying all 4,000 plus stocks in exact proportions would be incredibly expensive and inefficient, they use optimized sampling to hold a highly representative basket of those stocks that tracks the index seamlessly. But it is not all sunshine and rainbows. And to be objective, we need to talk about the potential drawbacks of this newly launched fund. While the 0.07% fee is phenomenal, this ETF is incredibly new to the market. It was just launched on April 8, 2026. Because it is so fresh, the assets under management, or AUM, currently sits at around 80 million euros. In the institutional ETF world, 80 million euros is quite small. To give you some stark contrast, the Vanguard FTSE All-World ETF has nearly 48 billion euros in assets under management. Why does fund size actually matter to you as a retail investor? It primarily comes down to liquidity and bid-ask spreads. When an ETF has billions in assets and massive daily trading volume, the gap between the price you can buy the fund for and the price you can sell it for is razor thin. For a smaller fund like ALW, the bid-ask spread might occasionally be slightly wider, which acts as a hidden transaction cost when you buy or sell your shares on the open market. Furthermore, some conservative investors have a strict personal rule against investing in funds with less than 100 million or even 500 million euros in assets, simply to avoid the risk of fund closure. If an ETF does not attract enough capital over time, the provider might decide it is unprofitable to run and shut it down. If that happens, your shares are liquidated and the cash is returned to you. You do not lose your underlying investment value, but it can trigger a highly unwanted capital gains tax event in your home country. However, I believe the closure risk here is quite low. DWS and Xtrackers deliberately launched this fund to engage in a relentless price war and capture massive market share from their competitors. They know it will take time to build $1 billion fund, and they are backing this project with their immense institutional weight. We are already seeing the assets grow rapidly as retail investors discover the lower fees, and many European brokers are already offering this fund for €0 on their automated ETF savings plans. Another metric we will need to monitor over the coming months is the tracking difference. This is a measure of how closely the fund actually follows its benchmark in the real world. A lower fee generally leads to a better tracking difference. But because the fund uses optimized sampling and is still in its infancy, we will need at least a full year of performance data to see if Xtrackers is replicating the index efficiently without internal friction. So the ultimate question for today: should you buy the Xtrackers FTSE All-World UCITS ETF over the established Vanguard VWCE? If you are just starting your investing journey today, the answer leans heavily towards yes. Getting comprehensive global exposure for just 0.07% a year from a highly reputable European asset manager is simply an unbeatable deal. Over a 30-year investing horizon, starting with the cheaper fund right out of the gate is the mathematically optimal choice, assuming the tracking difference remains tight. But what if you already have a substantial amount of money sitting in VWCE or an iShares equivalent? Should you sell your current holdings and switch to ALW? Generally speaking, no. Selling your existing shares could trigger a capital gains tax, depending on where you live in Europe. The tax you pay on those realized gains would mathematically wipe out decades of savings you might get from a 0.07% fee reduction. The most sensible approach for existing investors might be to simply direct all your future monthly contributions into the new Xtrackers ALW ETF, while leaving your existing Vanguard shares untouched to compound tax-free. To wrap things up, the ETF landscape in Europe is getting aggressively more competitive, and that is a massive win for retail investors. A 0.07% total expense ratio for a complete one-fund global portfolio would have been completely unimaginable just a decade ago. It gives you thousands of companies, exposure to both developed and emerging markets, automatic rebalancing, and optimal tax efficiency through dividend accumulation, all for a tiny fraction of a percent a year. Just keep an eye on the fund size and the bid-ask spread when you make your purchases. It is always a good idea to use limit orders to protect yourself from wide spreads. And always remember to invest consistently for the long term. Thank you so much for tuning in. If you found this deep dive helpful and informative, make sure to like the video and subscribe for more objective, numbers-driven financial analysis. Happy investing, and I will see you all in the next one.